Well, joining me now to look at some of those themes in more detail is Homayoun Falakshahi, Senior Commodity Analyst at Kpler. Well, thank you for joining us today, Homayoun. And firstly, let's start with your take on that apparent reluctance of OPEC Plus to ease oil markets with more output. Is that they can't or they won't?
Ryan, thanks for having me. I think it's a bit of both, but it's for sure they can't really do much more. I mean, we view spare capacity within the group at just 2 million barrels per day, mostly held by Saudi Arabia and the UAE. That doesn't fall within the actual plan of the production easing that has been going on over the past 2 years. So they're likely, Saudi Arabia and the UAE, they're likely to increase production starting from the month of September. That will not be linked to the current schedule of easing cuts. But again, spare capacity remains tight, even with those 2 million barrels per day included from these two countries. Fundamentals remain tight globally. So having sanctions on Russia, Iran, Venezuela at the same time means that the fundamentals are going to remain tight over the next few months.
Let's move on to the other big development, the G7 price cap on Russian oil. As we heard earlier, export revenues rose in May as volumes fell. I mean, will the cap do anything to change that?
So it remains to be seen whether that will be implemented. I think it's a very ambitious plan from the G7. It really remains to be seen whether countries such as China and India will follow suit. I think as long as we don't have secondary sanctions type of sanctions on Russia, meaning comparable to the ones we have on Iran, I don't think we'll see a big decline in Russian oil exports anyways. And again, right now it suits India and China well to buy Russian oil at a $30 per barrel discount. So again, I think this is highly unlikely to take place in the next few weeks.
And so broadly, what about prices? Where are they heading over the rest of the year and into next year?
So I think it's been very volatile, obviously, over the past few weeks, mainly due to fears of demand destruction. So we're starting to see some of that destruction take place. You've had the latest EIA numbers revealing gasoline stocks build. In the US, we're seeing stocks remain steady in China, despite the lockdowns being eased. So I think we're starting to see some signs of demand destruction. But at the same time, if you look forward towards the next 6 months or 12 months, again, the fundamentals remain very tight. So we still have a kind of bullish view on prices, and we think they can go higher from here. But again, in the short term, it's very volatile. It can go much lower, obviously.
And finally, let's just finish with that news on Germany's Uniper going to the government for potential bailout. How significant is that, and could we see that pattern across the rest of Europe?
Absolutely. I think we're talking about a company that has received about 40% of the gas it has ordered from Gazprom since the middle of June. And to replace that lost volume, what they're doing is that they're having to buy gas on the spot market, which, as you know, is incredibly high right now. So Uniper is having this issue, and that means that other European utilities are also having this issue. As you know, the Nord Stream 1 pipeline has been disturbed by some technical issues officially. Whether this is the actual reason remains to be discussed. But anyways, yes, Uniper is the main one being under threat, but it means that other utilities in Europe will also be under threat.
Homayoun Falakshahi, Senior Commodity Analyst at Kpler, thank you very much for your time.